Hello everyone, welcome to part 8 of this mini-series about project control, and I'm going to talk now about variance analysis. Right, so we've been talking a lot about comparing our performance to the plan and so on, but how exactly do we do that? Well, we do that by using a tool called variance, and variance is very simple. It's a quantifiable deviation or departure or divergence away from a known baseline or project value. In other words, is the difference between what we were planning to get and what we actually got. Okay, so I'll go into the calculation later on, but it's important here to express that variance means that something did not go according to plan. Now, there's going to be two different types of variance: positive variance, which is good; negative variances, which is obviously bad. Okay, and variances does not necessarily mean that it's always reality. Sometimes there are mistakes that can be done in the calculations, okay? But variances typically occur for two main reasons: either because it's an error of planning, okay, in other words, a human mistake, or it's really a mistake from something that happened, like an unexpected project performance that happened and affected our baseline plans. Now, there's three major types of variance here that we need to know. So three different things that I want to talk about. The first one is current period variance. Now, this is the variance that occurs in the current period. So for example, the example of the budget. For this month, I was supposed to spend 10,000. I spent 11,000, variance of $1,000 positive. Trend variance is the cumulative variance from the beginning of the project. Maybe for this month, I actually have a variance of 1,000, but since the beginning of the project, and if we do all the total, actually, I was supposed to spend so far, let's imagine $100,000, but I only spent 90,000. So actually my variance is negative 10,000. Earned value management variance. This is basically a different way of calculating variances, and it separates cost and schedule impacts here, and we're going to cover that in a little bit. Now, actual cost is another concept, and remember, actual cost is the realized cost, okay, for the work performance on an activity during the time period, during the specific time period. This basically means how much I actually spent, how much was my actual cost. And this determines by the business financial accounting systems, obviously. So there's a couple of calculations that must be done, and sometimes we don't have access to the real number. And it also can be segmented in many cost categories. For example, I typically divide costs into purchases and labor, and therefore I tend to separate those because I believe there are the two most important components. But depending on the project, I might separate it into different types. And there's two ways to express actual cost: current actual cost, so the cost collected for this period, for the project during this period, and the cumulative actual cost, which is basically the amount collected since the project start. So how do we calculate cost variance? Cost variance is the amount of budget, deficit, or surplus, so in other words, the negative or positive difference at a given point in time, expressed as the difference between earned value, or EV, and actual value, or AC. So our cost variance will be the earned value minus the actual cost. So if you have a negative cost variance, that means you have an overrun. If you have, in this case, a positive cost variance, then you will have an underrun. Now, accurate cost variance must compensate for whether the project is ahead or if it's behind schedule, and therefore there's a couple more details that I will have to talk later on about this calculation. Another variance we can calculate is schedule variance, very similar to cost variance, because schedule variance is a measure of schedule performance expressed as the difference between the earned value, or EV, and earned value can be as well for the schedule calculations, and the planned value, or PV. So the schedule variance will be earned value minus the planned value. So what will happen if you have a negative schedule variance? That means that you are delayed on the project. If you have a positive schedule variance, means that you are ahead of schedule, and in other words, that's good. Okay, to have accurate schedule variances accounts for underruns or overruns on the finished work, and therefore it is always important that we try to keep our if we could keep our variance on the positive side to get some extra time in case something goes wrong, that's always a positive thing indeed to have, because it gives you a little bit more reserves compared to the ones you already had, obviously, if that's the case, and therefore it can guarantee that you finish the project on time. Now, just as an example, I just want to show a couple of things that this graph will express just to understand the differences. Now, the blue line that you see is called the planned value. So this is my plan with the forecast for the future. At the end, I have this point, which is the BAC. Okay, and the BAC stands for budget at completion, and I plan to spend less than this black line over here that represents my project budget. And this difference that you see over here is my management reserve. Okay, I'm not going to worry too much about this area. Let's go focus again on the part about the now. Now, right now, my earned value, okay, right now is a little bit below than my planned value. And this is not good because it basically means I have actually done maybe less work, or I have spent less hours than what I planned to spend in order to earn the value of this project. My costs so far are increasing at quite a higher rate, okay? And that means that according to my plan, I actually am spending more than what I planned to spend, and that's not good, right? So what we have here? What we have here, this difference over here, because I'm measuring value of my project through the time I spend on my project, okay, this is my schedule variance. And this means that, in other words, I am underrunning in terms of schedule variance, which means I'm a little bit ahead of time, and that's good. But on the other hand, okay, if you notice, my AC is up, okay, which means that I'm spending more money than what I should have done. And that, okay, the difference between my AC and my actual earned value, how much I actually have there, this is my cost variance, okay? So to summarize, calculating variances is important, and it is important that indeed we have these calculations in mind, because basically they know if something starts to go wrong, we can detect much easier and much earlier if that things are going wrong, and we can take a corrective action. Without knowing our variances, it's a little bit like navigating in the dark, okay? You never know if you really are going the right direction or not. Thank you very much for watching the video. Let me know if you have any questions, and I'll see you on the next video of this mini series.